This is Andrew Stotz of Stotz Investment Research looking at my China Equity FVMR snapshot. Remember that FVMR stands for Fundamentals, Valuation, Momentum, and Risk. Those are the factors that I like to look at. So first of all, we're looking at China. So what do we see? First thing we can see is that the ROE of China is about, let's say, 10 to 11%. Versus the world, which is at about, let's say, 13%. So a slightly lower ROE. Now, what I'm going to look at next is the PE. And the PE of the world is, let's say, about 16 times, and China's about 20 times or so. Now, what's important here, this shows that China is actually pretty expensive relative to the world with no big premium for an ROE. In addition, what we can see is you're paying 21 times for analyst forecasts of about 1.8. Now remember that these is an aggregation of 1,884 Chinese companies. So these are China A shares. This is the real China. Now, it's possible that you will not be able to invest in many of these companies because most people can invest in China through China H shares. So China H shares are represented in this, but mainly this is China A shares. And what we can see is that also what we want to look at is that EPS is coming back at 19%. So you're going to pay 17 times for 2018 earnings, and they're going to be growing at 19 times according to analysts. Now, analysts tend to be overly optimistic, but I want to draw your attention. If the market is trading at 21 times, what I want to draw your attention to is down, down, down to the bottom. And what you can see is that no. The market isn't trading on 21 times. The market's trading on 33 times. Now, what do I mean by this? Well, the banking sector in China has a PE of, let's say, 10 to 13 times. And it accounts for about 30% of the overall China A shares market or overall China market. So therefore, when we back out these financials, which tend to be cheap, that's the case all around the world, they tend to trade at lower multiples and lower price to book. What we see is that the Chinese market's trading on about 33 times, and that's for about 14% growth right there. So China is a bit expensive, but wait a minute, look at that. Almost 40% analyst forecast for 2018. Let's say that analysts are overly optimistic by 50%. We're still talking about 20% growth. So maybe it's worth it to pay a 20 to 30 times PE for non-financial companies to get close to a 20 to 40% growth rate. Of course, that's the growth of China. Now, we can see that every single sector here has got positive growth expectations. Again, analysts tend to be optimistic, but of course, China is growing relatively fast compared to the rest of the world. In fact, if we want to look outside of the world, we can see that some companies are trading. Let's see what we can find here. Consumer staples companies are pretty cheap, about 15 times. Not bad. And we can see that kind of telecoms, this is a little bit of a difficult situation right there where we have a really, really low or negative EPS, which is an exceptional item. So therefore, that PE probably doesn't make sense, and that probably doesn't. So it's better than, in this case, for telecoms to look at the price to book, since that's an accumulative number, accumulated, and that's about 2.8 times price to book, which isn't that expensive. But what I want to look at here is what we can see is that the consumer staples sector is you're paying about 15 times for ROE of about 15 times and EPS growth of 17 to 18 times. So that looks pretty nice, and those companies in the consumer staples business are cash rich. When it's a negative, of course, they've got a lot of cash. Now, what we can also see is that share price performance has been good, but still, valuation is not bad. So consumer staples is a good place to look within China because a lot of China can be expensive. Now, we can also see that the level of gearing in China is, we can look at these two measures. It's hard to get the exact data on this, but let's say that for the past 12 months, the gearing in China is slightly less. But if we look at 2015, it's slightly more. So this is a little bit of a difficult number to interpret, but I would say at this point, China's gearing is not out of control for the corporate China. Of course, that's a whole different story compared to the amount of debt that the government has, which is different. But I think that the main thing I would highlight here is that companies are not overextended in their debt, at least for these listed companies. And next, what I want to show you is the volatility. And what we can see is that the volatility is lowest here in the utility sector, which makes sense. And then also we can see low volatility here in the financials right now. The highest volatility is coming from the telecoms, where we saw a lot of volatility in the earnings. And we can also see that the highest volatility otherwise is coming from materials, which is recovering. We can see a earnings recovery here in the materials sector, and materials is therefore trading at a higher and higher price to book. So that gives you a breakdown on China. What I would say is China's trading on about 20 times PE, or let's say 21 times 2017. But if we exclude banks, that's about 33 times. But keep in mind that if we look at the growth for China for 2018, it's about 19%, and 2018 ex-banks is about 40%. So the growth is still there in China, and if you're domestically in China, the market still looks attractive. Outside of China, you're going to have to invest in China A shares, which is mainly financials, which tends to be pretty cheap at this point. So there you go. That's the China Equity FVMR snapshot. If you want to look at your country, or if you have a question, just leave it in the comments below. Have a great day.